Welcome to Financial Focus, brought to you by GulfCoast Financial Services founder and CEO, John Kuykendall. John and his team of financial, legal, and tax professionals have been providing North Florida savers and investors sound, comprehensive financial guidance for over 30 years, helping you to achieve important life and planning goals. Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting GulfCoastFinancial.net.
And welcome into the program. This is Financial Focus, brought to you by the best of the best in financial services, as named by the readers of the Lake City Reporter. 8 straight years and running. The team from Gulf Coast Financial Services celebrating 31 years serving proactive North Central Florida savers and investors in formulating the plan to work to accomplish your important financial and retirement goals. CEO and founder John Kuykendall here with us as always. And John, it is a pleasure today going to review 9 critical risks that every retirement plan should address.
Well, that's right, Peter. We want to talk about those. They're very, very important. But you know, the biggest thing going for us now is we just need to plan. I don't know whether you realize this, but I read something last week that 11% of retirees over 65 are living on Social Security alone. Now, you know, that's not a lot of money, as we know. And we know that it's very difficult to, on this day and age with inflation, what it is, to live on that amount of money. But the biggest thing is people aren't planning. And I think if we can take some of these risks and plan for them, then we can come up with a better income plan. And we talk about that all the time. The credit card debt in the United States is the highest it's ever been. We're looking at 157 million adults living paycheck to paycheck.
Less than paycheck to paycheck on borrowed money. And that's got to be especially painful right now, since those balances carrying over cost significantly more than they did just a year to 18 months ago.
Well, we don't have that free interest for 12 months anymore. You know, that's kind of gone by the wayside as interest rates have gone up. And a lot of these credit cards, we're talking about 20-25% interest. Yeah. So, you know, you can never get ahead of that. There's no way unless you're making large payments. But if you're living paycheck to paycheck, you can't afford to make any additional payments. So, you know, we really, in America, we really need to plan. And, you know, it's amazing to me that when we offer this free of charge, you know, we as a complimentary thing for people, I can't believe that more people don't take advantage of it and put off the procrastination and get it done.
Well, if you'd like to get a plan put together, whether you are in retirement, preparing for retirement, or maybe years away from retirement and want to get there eventually, then pick up the phone, give a call, take advantage of this complimentary service extension of the information here on the program, put to use, applied to your individual situation with that financial focused written retirement income plan. 386-755-9018, 386-755-9018. 386-755-9018, or you can visit online, GulfCoastFinancial.net, GulfCoastFinancial.net. You can click the button to connect with us, and you can just get your information out, and we'll set up a convenient time to begin that conversation in the process of putting that plan together, or reviewing and evaluating the current plan, the setup, the individual accounts, and the positions and investments that you hold, to make sure that you understand all of these 9 critical risks that you need to plan for in order to have a more stable, secure, and confident retirement. And John, you're right. There is a retirement crisis. We are significantly underfunded, but even people who are well-funded may not have addressed these 9 critical risks to plan for, because several of them really don't play a significant factor during our working career.
Well, that's right. You know, and the first one, what we're going to talk about, which is sequence risk, doesn't have anything to do with while we're working, because we're not drawing money out of our retirement accounts. But, you know, when we retire, we have to pay ourselves. And so we pay ourselves by taking that money out of our assets that we've saved up. And so we know that in this market, when we're showing losses predictably every month, and it's been some time, 2022 was not a great year for the stock market. We know that On average, the stock market averages 9%, but it doesn't do that every year. And so when we look at taking money out in a down market, it's been proven that our money will not last as long as if we take it out in an up market. And so it's just those couple of years when we first start retiring, we kind of have to get ahead of it, I guess. But it's the way we draw our money out and the way we plan to draw it out. And sequence risk is a big thing that a lot of people have never heard of, and people aren't concerned with it because while we're working, it doesn't make any difference.
Yeah. And so we do experience the opposite force, which has worked in our favor and advantage during our working career, dollar cost averaging. But in retirement, the tide turns, and now we are removing money, taking withdrawals while the tide is going out. That can spell for disaster. John, the next one, legislative risk. And we've actually seen a lot of this. The government can change the rules on us on many aspects. And I think we'll get to taxation specifically a little later, but they can change the rules on a lot of different elements that is going to impact our retirement.
Well, we saw it in December of 2019 when we came out with the Secure Act, which was the elimination of the stretch IRA. In other words, after my wife and I had passed away, our subsequent heirs used to be able to take it out over their actuarial lives if we hadn't started taking RMDs, or over the remainder of my life or my wife's life if we had already started taking RMDs. But now that's gone away. So that's an example of legislation. We just got through with the Secure Act 2.0, which was given to us in December of 22. And so that, while it doesn't impact individuals very much, it does have a significant impact on some business things. And legislative changes, taxation and legislative changes can make a big difference in our retirement and how we're going to retire and the type of retirement that we're going to have. It's something that you and I can't really plan for, Peter, because God knows only the legislators know what they're going to give us.
Yeah, and things like Social Security and Medicare. At some point in time, John, I have to imagine there's more changes coming to those systems, more because they've changed them before and they're likely to change them again, hopefully to make them more secure and solvent. But probably that means that we receive less at some point in time.
Well, that's true. And as I've said many times on this show, during the Jimmy Carter administration, we actually had a 25% haircut in Social Security benefits for some active participants during a certain age bracket. And so Jimmy Carter went in and carved out 5 years of people who had their birthdays during those 5 years, were born, and gave them 25 cents less on the dollar than they get, and then everybody else was getting, in order to keep Social Security viable. So there's nothing that's saying it can't happen again. Social Security and Medicare are both supposed to run out of money, or at least not be able to give all of the money that they're currently liable for shortly. I mean, it's right around the corner. The 2030s are coming up pretty quick here. And so there's going to be some changes to Social Security before that. It's going to affect us. It's going to affect the amount of money we get. And if we're living only on Social Security, we're going to have that other haircut. And you forget that while you might have a house with two Social Security benefits, if one spouse passes away, I get the higher, but I lose one.
Yep. Spousal income dependency, another critical risk that pertains to Social Security and to pensions. Sometimes we look at the different choices and options. We see the highest amount of income. It looks attractive, but we also potentially leave a spouse with a significant decrease if it is a single life only higher income. So careful considerations to work through, and important decisions and significant consequences with those decisions on Social Security and pensions. And then, John, we've talked about the third one here very frequently, is that people tend to have a perception that they can take more out of their investment accounts in the first several years of retirement than is really sustainable to last over the duration of their retirement withdrawal rate risk.
Well, that's right. A lot of people think because the stock market makes 9%, 10% on average over its lifetime, I can draw out 5-6% and I'm not going to crash my account. But we know that's not true. According to the Wall Street Journal, the actual number that you can pull out is like 1.78%, not 4%. So the more we draw out of our account in the early stages and later, the more chance we're going to have to run out of money. And so it's kind of like that Halloween candy. I want to give out as little as I can in the beginning, but I still want to have enough to make it worth your while to come knock on my door. So it's a fine line, Peter, between too little and too much. But 4 or 5% may be too much. And you'll be surprised at the people that think they can draw 6% out.
Well, and then they are doing so relying on some positive growth and often case market-based returns on their nest egg. Well, we know that the market isn't always predictable. We can certainly say that looking back at 2022, John. So market volatility, another critical risk that every retirement plan needs to address.
Well, that's right. And we're going to have market volatility. It's natural. If you look at the market, on a close basis, it looks like an EKG. It goes up, it goes down, it goes up, it goes down. If you look at it over a long period of time, yes, it is historically always up. The curve is up, but that's over a long period of time, stretched out for longevity. We can't predict what that market volatility is going to do. And that, Peter, is what I think happens when people deal with asset allocation plans instead of income plans.
Yeah. And John, a big difference, a distinct differentiation that you have talked about very often is that growth and accumulation plan is built different, is geared different, is set up to help us achieve very different goals under very different circumstances than what the retirement plan, the financial focused written retirement income plan, needs to be designed and geared to help us accomplish.
Well, there's no doubt about it that an income plan giving me predictable, sustainable income over my life expectancy, taking in consideration for inflation and other factors, is going to give me the better retirement. Asset allocation is built for while I'm working and growing my portfolio, and I can take some risk. But in retirement, I want to get out of asset allocation and get into income planning. It's the only way to go for retirees.
Well, a few others on this list here. And by the way, ladies and gentlemen, if you would like this complete list of the 9 critical risks to plan for and address in retirement, pick up the phone, give a call. It's actually part of a larger package of the Countdown to Retirement, a full series of comprehensive reports, informative information on what you need to be doing and addressing. And John and the team there at GulfCoast Financial Services, happy to provide that for listeners of this program. You can go through this information on your own, review it, and then you can always come in for that complimentary review and the no cost, no obligation, financial focused written retirement income plan, which would address all of the aspects in the Countdown to Retirement and these 9 critical risks. So give a call, 386-755-9018, 386-755-9018, 386-755-9018, or you can visit online, GulfCoastFinancial.net, and just click the Connect with Us button or enter your information to set up a time for a complimentary review or to request that download, GulfCoastFinancial.net. All right. So, John, rounding home here, these are like the big ones, I think: taxation, inflation, and then the risk multiplier we've talked about, longevity. All of these are huge issues that many of us have actually set ourselves up on the wrong side of the equation and the assumptions that we're making.
Well, that's right, Peter. And I think we've been set up by the government because the government has encouraged us to tax defer our savings for a long time. Take it out pre-tax. Taxes will be cheaper in retirement. You're always making less, so therefore you're going to be paying less. And what we've proven is that's not true. Taxes are one of the most important things that we have to face as retirees, because taxes affect everything. The more money we make, the more taxes we make, the more Social Security gets taxed, the more Medicare we have to pay for. So, we have to be careful in retirement, and taxation is certainly a big one. And I don't think a lot of people understand out there because it's kind of sneaking up on us. But in December of 2025, December 31st, we go back to the old tax tables. And so we lose that huge standard deduction that we've got now, and we eliminate the tax brackets. And so the highest tax bracket now becomes 39% again. So there are a lot of things that are going to happen to taxes between now and 2025. And as retirees, we need to be ready for them and anticipating and have included those in our plan.
Well, it's not just the highest tax bracket. It's not just those making over 400,000 or whatever language you want to use. The 10%, I believe, stays the 10%, but even the 12% jumps up to 15, the 22 goes to 25, 24 to 28. Basically, we are going to be paying more taxes across the board on the vast majority of all of our income. And all the folks up there in Washington can basically say, I didn't do that. That was already on the books, already in the rules, right, John?
Yeah, that's right. It wasn't anything I did. But the big thing is that standard deduction for seniors, $27,000 that we're not going to have available, and we may not have those kind of deductions when we itemize. And so we are going to be paying more in taxes unless something changes. So we need to be ready for that. We need to anticipate it, and we need to get a hold of our legislatures and legislature and talk to them and explain to them how critical it is. And the last one, Peter, on here is longevity. And longevity, we're living longer. And just because, I talk all the time about Tom Hegney and his 3 phases of retirement, the go, slow go, and no go. Even though later in life, we're going to be in our no go, we're not going to be wanting to go out as much. We're not going to be able to travel. We still have to pay the rent or the nursing home or something, and we still have to buy groceries. And so we still need income as long as we live.
Yeah. And those even baseline expenses have gotten more expensive over time and will continue to do so into the future. So we've got to plan and prepare for inflation, for longevity, for taxation, market volatility, for all 9 of these critical risks on this list. If you would like the list to sort of consider your approach and how your plan addresses them, or if you would like that complimentary review and no cost, no obligation, written, financial-focused retirement income plan, pick up the phone and give a call. 386-755-9018, 386-755-9018, or you can go online, GulfCoastFinancial.net, GulfCoastFinancial.net. John and his team standing by, looking forward to help and assist in any way they can, get you pointed in the right direction, get you a solid plan for financial confidence, lasting financial confidence in your quality of life, that financially focused written retirement income plan in your hands. 386-755-9018. John, it is always a pleasure getting the opportunity to see you, speak with you here on the program.
Thank you, Peter. It was great to be here, and have a good week.
Be sure to like, subscribe, share, and tune in for more financial focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovacs Securities, Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through GulfCoast Financial Services, Inc., a registered investment advisor in Florida. GulfCoast Financial Services, Inc. is not affiliated with with Kovac Securities Inc. or Kovac Advisors Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.